For most of the past decade, silver existed on the margins of global finance. It was discussed occasionally in commodity reports, sometimes mentioned in inflation debates, but rarely treated as something capable of reshaping markets. Analysts described it as stable, predictable, and largely unexciting. Compared to technology stocks, cryptocurrencies, or even energy markets, silver appeared slow and uneventful. That perception shaped behavior. Large institutional investors paid little attention to it. Portfolio managers focused on growth sectors. Policymakers barely mentioned it. Silver was assumed to be available, affordable, and replaceable if necessary. It was not viewed as a strategic vulnerability. That assumption is now being challenged. Within a single week, silver prices moved in a way that financial markets typically associate with systemic stress rather than normal trading. Such movements are not simply about speculation or short-term sentiment. They are usually signals that something deeper has shifted beneath the surface. When prices move this quickly, it often reflects a reassessment of scarcity rather than enthusiasm. To understand why this matters, it helps to step back and examine what silver actually represents in the modern world. Silver occupies a unique position among commodities. It is both an industrial material and a monetary metal. Few resources sit at this intersection. On one side, silver plays a critical role in advanced manufacturing and infrastructure. On the other, it carries thousands of years of history as a store of value. These two identities interact in ways that can amplify market stress when supply becomes constrained. From an industrial perspective, silver has characteristics that are difficult to replicate. It is the most electrically conductive metal known. This property makes it essential in environments where efficiency, reliability, and durability are non-negotiable. Modern electronics depend on it. Renewable energy systems rely on it. Communication networks, medical devices, and defense technologies all incorporate silver in ways that are not easily substituted, without sacrificing performance. In solar energy alone, silver plays a central role. Photovoltaic cells use silver-based conductive paste to collect and transmit electricity generated by sunlight. Alternatives exist, but they reduce efficiency and durability. In a competitive global energy market, even small efficiency losses can determine whether a project remains viable. Electric vehicles also depend on silver. Their electrical systems, battery controls, power management components, and charging infrastructure all use it in small but critical quantities. Individually, these amounts may appear modest. At scale, across tens of millions of vehicles, the demand becomes substantial. Telecommunications infrastructure adds another layer. High-frequency networks require materials that maintain signal integrity under increasingly demanding conditions. As networks evolve, material tolerances tighten, not loosen. Silver's role becomes more important, not less. These industrial uses are not discretionary. They are embedded in the technologies that governments and corporations have committed to expanding over the next several decades. Energy transitions, digital infrastructure upgrades, and electrification strategies all assume that silver will remain available at manageable costs. At the same time, silver's supply dynamics are fundamentally constrained. Unlike oil, agriculture, or even some base metals, silver production cannot be rapidly increased in response to higher prices. The majority of silver mined globally does not come from primary silver mines. Instead, it is produced as a secondary output of mining operations focused on other metals such as copper, lead, and zinc. This means silver supply responds indirectly to the economics of entirely different markets. When silver prices rise, mining companies cannot simply decide to produce more of it unless the primary metals they mine also justify expanded production. This disconnect creates rigidity on the supply side. Even sustained price increases may take many years to translate into meaningful additional output. Global mining production grows slowly and predictably. Geological constraints, permitting timelines, environmental regulations, and capital requirements all limit how fast new supply can come online. In practical terms, this means that silver supply is relatively fixed in the short and medium term. Demand, however, is not. Industrial demand has been steadily increasing, driven by structural changes rather than cyclical trends. Energy systems are becoming more electrically intensive. Devices are becoming more complex. Infrastructure is being rebuilt for higher data throughput and greater efficiency. These trends are long-term and policy supported. At the same time, investment demand for silver has remained persistent. Individuals, institutions, and governments have continued to accumulate physical silver as a hedge against monetary instability and currency debasement. While this demand fluctuates, it adds another layer of pressure to an already tight supply balance. For many years, the gap between supply and demand was manageable. Above-ground inventories, recycling, and government stockpiles helped absorb shortfalls. Markets functioned smoothly because there was confidence that additional metal could be mobilized if needed. That confidence is now eroding. Publicly available data indicates that many of these buffers have been significantly reduced. Government silver reserves that once acted as stabilizing mechanisms are largely gone. Recycling responds to price incentives, but cannot instantly replace primary supply. Exchange inventories fluctuate, but they are not infinite. As these buffers shrink, price becomes the primary tool for rationing supply. When that happens, markets tend to move quickly and sometimes violently. Prices are no longer just signals of value, they become mechanisms for allocating scarcity. This shift has implications far beyond the silver market itself. Modern financial systems are built on assumptions of continuity and predictability. Corporate valuations rely on stable input costs. Long-term contracts assume manageable price ranges. Growth projections assume that materials will be available when needed. When a critical input begins to behave unpredictably, those assumptions weaken. Companies that operate on thin margins are particularly vulnerable. If they cannot pass higher costs to consumers quickly, profitability erodes. If long-term contracts lock in prices that no longer reflect reality, losses accumulate. Over time, balance sheets weaken and investor confidence fades. This is not an abstract risk. History offers multiple examples of how sudden commodity constraints have reshaped economies. In the 1970s, oil supply disruptions revealed the limits of government intervention in physical markets. Policymakers attempted price controls, rationing, and diplomatic pressure. None of these tools could override geological and geopolitical realities. The result was prolonged inflation, economic stagnation, and market volatility. Silver today occupies a different role, but the underlying lesson is similar. Physical resources operate under natural constraints that financial systems cannot fully override. What makes the current situation distinctive is that silver sits at the center of technologies that governments are actively promoting. Energy transitions, defense modernization, and digital infrastructure all depend on it. This creates a tension between policy objectives and material realities. Governments can influence demand through regulation and subsidies. They can influence financial conditions through monetary policy. What they cannot do is manufacture physical supply on command. This realization is slowly filtering into markets. When participants recognize that scarcity is structural rather than temporary, behavior changes. Companies seek to secure supply. Investors reassess risk. Prices adjust not just to current conditions but to future uncertainty. The recent movement in silver prices reflects this reassessment. It is not merely a reaction to news or sentiment. It is a response to the recognition that a critical material may no longer be as abundant or controllable as once believed. As this understanding spreads, its effects will extend beyond commodities. Equity markets, particularly sectors heavily exposed to material inputs, will need to reprice risk. Growth assumptions will be tested. Some business models will adapt, others may not. This is not a sudden collapse, but a gradual confrontation with physical limits. In the next part, we'll examine how geopolitical decisions and supply chain dynamics have accelerated this shift, and why certain regions now hold disproportionate influence over the outcome. For most of the modern era, global commodity markets operated on a shared assumption that supply chains, while occasionally disrupted, would ultimately adjust. Production would shift, trade routes would adapt, and prices would stabilize. This belief was reinforced by decades of globalization, where efficiency, specialization, and international trade smoothed over local shortages. That assumption is now under strain, not because of a single event, but because of a convergence of long-term forces. One of the most important of these forces is geopolitics. In recent years, governments have increasingly treated critical materials not as neutral trade goods, but as strategic assets. Energy security, technological independence, and industrial resilience have moved to the center of national policy. This shift has altered how countries think about exporting and importing essential resources. Silver has quietly become part of this strategic calculation. Unlike oil or rare earth elements, silver rarely appears in political speeches or headlines. Yet it underpins many of the technologies that define economic and military power in the 21st century. Advanced electronics, renewable energy systems, and high-frequency communications all rely on it. Control over its processing and distribution therefore carries influence. China occupies a central position in this landscape. While China is not the largest miner of silver, it is one of the world's most important refiners. Refining is the stage that turns raw ore into forms suitable for industrial use. Without sufficient refining capacity, mined silver cannot easily enter high-value manufacturing supply chains. Over the past 2 decades, China invested heavily in refining infrastructure. This investment aligned with its broader strategy of becoming a global manufacturing hub. By controlling more stages of the supply chain, China reduced dependence on external suppliers and increased its leverage in global trade. As renewable energy and advanced manufacturing expanded, this leverage became more consequential. At the same time, China's domestic demand for silver grew rapidly. Solar panel production scaled at an unprecedented pace. Electric vehicle manufacturing expanded. Electronics exports increased. Each of these sectors consumed silver in ways that were incremental individually, but substantial in aggregate. Faced with rising domestic needs and an uncertain global environment, policymakers began to prioritize internal supply security. Rather than framing this shift as a dramatic policy announcement, it was implemented through regulatory mechanisms. Export requirements became more complex. Licensing thresholds increased. Compliance costs rose. These changes did not eliminate exports entirely, but they made them more selective. From a geopolitical perspective, this approach offered several advantages. It allowed domestic manufacturers to secure supply without provoking immediate diplomatic backlash. It encouraged consolidation within the refining industry. And it signaled, subtly but clearly, that silver was no longer treated as an unlimited export commodity. For countries reliant on imported refined silver, this created new vulnerabilities. Western manufacturing sectors had long optimized for cost efficiency. Just-in-time inventories reduced storage expenses. Supply chains were built on the assumption that refined materials could be sourced reliably from global markets. When access becomes uncertain, these systems struggle. Manufacturers typically hold limited inventories of inputs, like silver. Storage ties up capital, and materials that appear abundant are not stockpiled aggressively. This strategy works until availability is questioned. At that point, companies begin competing for supply. This competition does not occur in an orderly fashion. It often starts quietly, with procurement teams seeking longer-term contracts or higher volumes. When suppliers cannot meet all requests, price negotiations become tense. Premiums emerge. Contracts include priority clauses. Smaller buyers find themselves sidelined. As this process unfolds, prices can move rapidly, even before physical shortages fully materialize. Markets are forward-looking. They respond not only to current supply, but to anticipated constraints. Financial institutions play a role here as well. Large market participants often have access to detailed data on inventory levels, shipping flows, and industrial demand. When these indicators suggest tightening conditions, positioning changes, hedging strategies evolve. Some institutions reduce exposure to price suppression mechanisms and allow markets to reprice. This is not necessarily coordinated or conspiratorial. It is a rational response to shifting risk-reward dynamics. When scarcity appears likely, maintaining positions that cap prices becomes increasingly risky. The result is a market that transitions from stability to volatility. As silver prices rise, the impact on industrial sectors becomes more visible. Input costs increase, margins narrow, companies reassess production schedules and investment plans. Sectors with the greatest exposure tend to feel pressure first. Renewable energy manufacturing is particularly sensitive. Solar panel producers operate in highly competitive markets with limited pricing power. Contracts are often negotiated years in advance. Sudden increases in material costs can transform expected profits into losses. Electric vehicle manufacturers face similar challenges, though the effects are distributed across more components. While silver is not the largest cost input, it contributes to systems that are difficult to redesign quickly. Cost increases accumulate across production volumes. Technology companies, especially those producing consumer electronics, must balance cost pressures with price sensitivity. Raising prices risks reducing demand. Absorbing costs reduces margins. Neither option is ideal. Defense contractors occupy a different position. Government contracts may allow for cost pass-throughs, but these adjustments occur within political and budgetary constraints. Delays are common. In the interim, financial performance can be affected. As these pressures build, equity markets respond. Valuations reflect expectations about future earnings. When input costs rise unpredictably, confidence in those expectations declines. Investors demand higher risk premiums. Price earnings multiples compress. This process does not require a recession to begin. It can unfold even in a growing economy if cost structures become unstable. Another layer of complexity comes from financial leverage. Many institutional investors operate across asset classes. They may hold long positions in equities while maintaining hedges or exposures in commodity markets. When commodity prices move sharply, margin requirements change. Capital must be reallocated. Liquid assets are sold to meet obligations. In such environments, equity markets can experience selling pressure that appears disconnected from company fundamentals. The link, however, runs through balance sheets rather than earnings statements. This dynamic has appeared in previous periods of market stress. When one segment of the financial system experiences rapid revaluation, the effects propagate through portfolios. Governments monitor these developments closely, but their options are limited. Monetary policy can influence financial conditions, but it cannot create physical supply. Interest rate adjustments may affect demand at the margin, but they do not resolve material constraints. Fiscal subsidies can support industries, but they cannot guarantee access to scarce inputs. Diplomatic engagement may alleviate some trade frictions, but it operates within broader strategic considerations. Countries prioritize domestic stability and industrial competitiveness. Resource security becomes part of national interest. This reality exposes a fundamental tension in modern economic governance. For decades, policymakers grew accustomed to managing crises through financial instruments. Liquidity, provision, stimulus spending, and regulatory adjustments proved effective in stabilizing markets during banking crises and demand shocks. Physical resource constraints operate differently. They are governed by geology, infrastructure, and long development timelines. When shortages emerge, they persist until supply increases or demand adjusts. Both processes are slow. This does not mean collapse is inevitable. It means adaptation is required. Industries may redesign products to use materials more efficiently. Recycling technologies may improve. New supply sources may be developed. Over time, markets find new equilibria. But during the transition, volatility is unavoidable. The silver market is now at the center of this adjustment process. Its price movements are not isolated events. They reflect a broader shift in how the global economy confronts physical limits. In the final part, we'll explore what this means for long-term market structure, how governments and industries are likely to respond over the coming years, and why this moment may signal a broader rebalancing between the financial and physical economies. As markets adjust to new constraints, attention naturally shifts from immediate disruption to longer-term consequences. The question is no longer whether silver prices can move sharply, but what such movements reveal about the structure of the global economy and its future direction. Periods like this tend to expose assumptions that were rarely questioned during times of abundance. For much of the past 4 decades, economic growth in advanced economies relied heavily on financial expansion rather than physical production. Capital flowed freely. Debt was inexpensive. Supply chains stretched across continents. Physical inputs were treated as stable variables rather than strategic risks. This environment shaped corporate strategy. Companies optimized for efficiency, minimized inventories, and prioritized return on capital. Shareholder value was maximized through financial engineering as much as through innovation. Physical resources remained essential, but they were assumed to be available when needed. That assumption is now being tested. When a material like silver begins to behave unpredictably, it forces a reassessment of what truly underpins economic activity. Digital platforms, financial instruments, and intellectual property all depend, ultimately, on physical infrastructure. Data centers require wiring. Energy systems require conductive materials. Transportation networks require metals and minerals. The boundary between the financial economy and the physical economy becomes visible during moments of stress. Governments, in particular, face difficult trade-offs. Policy goals, such as decarbonization, digital modernization, and industrial reshoring, depend on secure access to materials. At the same time, political systems are sensitive to inflation, employment, and market stability. When resource constraints drive costs higher, policymakers must balance long-term objectives against short-term pressures. Historically, this balance has rarely been smooth. In previous eras, commodity shortages often led to periods of adjustment marked by slower growth, higher prices, and structural change. New technologies eventually emerged. Supply expanded. Consumption patterns evolved. But these transitions unfolded over years, not months. Silver's current trajectory suggests a similar process. In the near term, industries most dependent on it will be forced to adapt. Some will secure long-term supply agreements at higher prices, locking in predictability at the cost of lower margins. Others will invest in research to reduce material intensity. A portion will fail, unable to adjust quickly enough. Markets will differentiate between these outcomes. Companies with diversified supply chains, strong balance sheets, and pricing power are more likely to endure. Those built on assumptions of permanently low input costs will face greater risk. Valuations will reflect this divergence. For investors, this environment rewards selectivity rather than broad exposure. It also encourages a re-examination of asset categories. Financial assets represent claims on future production. Their value depends on the ability of the real economy to generate goods and services profitably. When material constraints disrupt that process, those claims become less certain. Physical assets operate differently. They derive value from scarcity and utility rather than future earnings. When supply is constrained, ownership itself carries leverage. This distinction becomes more relevant as resource pressures intensify. It does not imply that physical assets replace financial ones, but it suggests that balance matters. Portfolios built entirely on assumptions of financial expansion may be vulnerable when physical realities intervene. The silver market illustrates this dynamic clearly. Its price movements are not driven solely by monetary conditions. They reflect geological limits, industrial demand, and geopolitical decisions. These factors operate largely outside the reach of central banks. This marks an important shift in market psychology. For many years, investors assumed that extreme outcomes would be mitigated by policy intervention. Central banks would provide liquidity. Governments would stabilize markets. Structural imbalances would be managed. Physical shortages challenged this belief. They introduce a domain where intervention is constrained by time, infrastructure, and natural limits. Policy can influence outcomes, but it cannot dictate them. As awareness of these limits spreads, expectations adjust. Risk premiums rise. Volatility becomes more accepted. Long-term planning incorporates a wider range of scenarios. Over time, this leads to structural change. Industries invest in resilience rather than pure efficiency. Supply chains shorten or diversify. Stockpiling becomes acceptable again. Redundancy, once viewed as wasteful, is reinterpreted as insurance. These changes may reduce profitability in the short term, but they enhance stability. On a global scale, resource-rich regions gain strategic importance. Countries capable of mining, refining, and recycling critical materials increase their influence. Trade relationships evolve accordingly. Silver is unlikely to be the last material to undergo this transition. As energy systems electrify and technologies grow more resource-intensive, pressure will emerge across a range of inputs. Copper, nickel, lithium, and rare earth elements all face similar dynamics, each with its own constraints and geopolitical dimensions. The silver episode can therefore be seen as an early signal rather than an isolated anomaly. It highlights the intersection of three forces shaping the modern world: technological ambition, geopolitical competition, and physical limitation. When these forces align, markets adjust rapidly. For individuals observing these shifts, the lesson is less about prediction and more about perspective. Periods of stability can obscure underlying dependencies. Periods of disruption reveal them. Understanding where systems rely on constrained resources provides insight into where vulnerabilities may emerge. This does not require alarmism. It requires recognition. The global economy has navigated resource transitions before. Each time, the adjustment involved trade-offs, innovation, and re-evaluation of priorities. There is no reason to believe the current period will be different in that respect. What is different is the scale and speed at which technologies now depend on specific materials. Silver's role in this landscape underscores a broader truth. Even in an increasingly digital world, the physical foundations of progress remain decisive. Code, capital, and policy all operate within the boundaries set by material reality. As markets continue to respond, narratives will evolve. Prices will fluctuate. Forecasts will change. But the underlying lesson will persist. Economic systems are ultimately grounded in the physical world. When that world imposes limits, financial abstractions must adapt. Silver's recent behavior serves as a reminder of that boundary, not as a crisis in isolation, but as a signal that the balance between finance, technology, and resources is shifting. How smoothly that transition unfolds will depend on preparation, flexibility, and an honest assessment of what can and cannot be controlled.